Hello, everyone, and welcome to the continuation of my IFRS IS 12 tax accounting course. In this video, I will start to talk about current tax. You'll recall that from my previous videos, I'd mentioned that there are two components to income tax. The first being current tax, and the other one being deferred. Current tax is a lot less complex relative to deferred tax, and that's why we are starting with it. So next point here is to talk about the meaning of current tax, and this definition is pulled from IAS 12, and IAS 12 says that current tax is the amount of income taxes payable in respect of taxable profits or income taxes recoverable in respect of tax loss. So when you've got taxes to pay to the tax authorities and it's an income tax, that's a tax payable, which you typically record as a current tax expense from a P&L perspective, or a current tax liability if you're looking at the balance sheets. And if you've got amounts recoverable, income taxes recoverable or receivable from the tax authorities in cases of refunds, then from a P&L perspective, you perhaps would have a current tax income, and from a balance sheet point of view, you will have a current tax asset. I should say that it's uncommon to have current tax income, and it's very uncommon to have current tax assets, but it does exist in reality. The second bit I like to talk about is the fact that ISF takes a balance sheet approach in accounting for income taxes. So when you're trying to determine the current tax for the period, it's not enough to look at the activities that has happened in that period. It's important to look at what the current tax position is as of the reporting date. So if the year end date is 31 December, you're not just concerned about what happened between Jan and December 2023, for example. You're concerned about that. Yes, we are saying that as at the end of 31 December 2023, what is my current tax position? How much taxes do I owe for the current period? And do I potentially owe additional taxes for the previous period that I wasn't aware of before now because of certain information that has come to my attention? So we just cannot look at what has happened in the current period alone. We need to look at the balance sheet data and say, is there anything else that I may not have considered? And we need to consider it. And that's why I say it takes the balance sheet approach. So you can read, I mean, what I've typed on the balance sheet approach is pulled from IAS 12, but that's the concept behind it. And we're going to do a couple of illustrations together so that you can appreciate what these things mean. And the next point here is that when there's a tax loss and the tax legislation allows you to carry back the tax loss to a previous period, then a tax refund is possible. So ISF says that if you are carrying backward tax laws and you're able to recover previously paid taxes, then you have a current tax asset that you must recognize. So that's the key points that we need to know for current tax. And so the next you will see now are certain illustrations to be able to further explain these points. So the first illustration says that we've got a company called Musk Limited that has reported a profit before tax of £100,000 for the year ended 31 December 2022. The tax manager of Musk Limited has looked at the account and has said that the taxable profit for the year is £120,000 after adjusting for certain non-deductible expenses. Musk Limited is a UK company and is subject to corporation tax at 25%. So down to the question, it says, determine the current tax expense for Musk Limited for the year ended 31 December 2022. And it puts certain notes there to say that corporation tax is the only income tax payable by companies in the UK. Musk Limited owes no corporation taxes from prior periods. So let's look at a solution to this illustration. So if you recall, the PBT is £100,000, and that's what you have here on the first line. You have a figure, and that comes straight from the illustration. The PBT is £100,000. The illustration says that the taxable profit is £120,000. What that means is that you would have tax-related adjustments of £20,000. And that's what you see in this illustration. So when you add £100,000 to £20,000, you have a total taxable profit of £120,000. Tax rate is 25%, and 25% of 120,000, you have a current tax expense of £30,000. So if this was the only thing that happened in the year, Musk Limited would have to book a current tax expense of £30,000. I mean, the focus of the course is the accounting bit of tax, so we're not going to talk about how those adjustments are determined. We're assuming that somebody else has done the tax calculations. You are trying to determine what numbers you put into the trial balance, into your GL, into your financial statement. So we're trying to focus on not how to calculate the tax itself. It's the accounting of the tax, if that makes sense. So second illustration, this is very similar to the first illustration. The additional point here is on paragraph 2, where it says that in November 2022, which is before the end of the year, HMRC, which is the UK Tax Authority, wrote to Musk Limited that it owes additional corporation tax of £20,000 relating to the previous year, which is the year ended 31 December 2021. The tax manager has looked at this and agrees to this additional corporation tax, but is yet to make payments. So the question is, determine the current tax expense for Musk Limited and also determine the current tax liability for the year ended 31 December 2022. So like I said, the starting point is very similar to the first illustration. So when we're looking at the solution, you will see that the first bit of the illustration is same as what we did in illustration 1. PBT is 100,000, tax adjustment is 20,000, and you have a total taxable profit of 120,000. And once you calculate tax at 25%, you have a current tax expense related to the current year of £30,000. Remember that in the illustration, the HMRC has said there's an additional exposure of £20,000. The tax manager says this is reasonable and has agreed to it. But because the company is just knowing about that additional tax liability in 2023, it needs to be booked as a 2023 tax expense. But for disclosure purpose, you will need to mention that it relates to the prior year. But it only came to be known in 2023, and that's why you book it as a current tax expense. But for disclosure purposes, you want to separate the current tax expense that relates to the activities of the current year and those that relate to the activities of previous years. And so in this case, your total current tax expense will be 30,000 plus £20,000, and that's a total of £50,000. Remember that in the illustration, it says that no taxes were owed in the beginning of the year. So what that means is that there was no opening liability, so your opening balance is 0. Your tax expense for the year, there are 2 components to it. You've got the 30,000 current tax expense related to activity for the year, and you've got the prior year number of £20,000. No payment has been made, so there's nothing to deduct. And what that means is that we have a total current tax liability of £50,000. It's pretty straightforward. And current tax in reality can be this straightforward. So let's go a bit further. And this is slightly complex, but I think it's still straightforward too. So we've got this company called Ingen Limited that was incorporated in Costa Luna on 1st of January 2022. And it commenced operations on the same day. And so it says that the financial reporting date, also the balance sheet date, is 31 December. And they've provided certain information below, certain data from Ingen's record. So it says PBT, taxable profit, and the tax paid for the year for 2022 and 2023. Next point here is that in Costa Luna, companies are permitted to carry their tax losses backward, which enables them to claim a tax refund of any previously paid taxes. They've also said that corporate tax rate in Costa Luna is 30%. So this is the background information. Now to the question. So the question says, determine the current tax expense for the year, for the 2 years, 2022 and 2023, and also prepare the current tax account for the 2 years, 2022 and 2023. So that takes me to the next slide. So, what you see on the left is is the solution to 2022, and on the right is 2023. So, if you go back to illustration, taxable profit for 2022. Oh, so I think there's a bit of mistake here, but let's just assume. Let's assume the taxable profit is 100,000 Costa Lunan dollars. Tax rate is 30%, and so the current tax expense for 2022 is 30,000 Costa Lunan dollars. Opening balance is nil because they started business in 2022, so there was no way they would have owed any taxes upon commencement. Current tax expense is 30,000 Costa dollars. No tax paid in 2022, and that gives you a closing balance of 30,000 Costa Lunan dollars. Pretty straightforward. And that has answered the two questions. The first bit is the current tax expense, which is 30K. The second bit is the current tax account. The current tax account is the breakdown. It's a roll forward from your opening balance to your closing balance. So you start with your opening balance, you talk about any expense that you have booked or any income that you have booked for foreign tax, any payment and any other adjustment that you didn't arrive at the closing balance. In this case, the only movement is the current tax expense. So between your opening and the closing balance, you have a current tax expense of 30,000. In some complex cases, you have a lot of elements of the movement. You will have payment, you will have foreign exchange, and a few other things. Yeah, but more often than not, what you commonly have will be payments, expense, or income for the period, and maybe FX. Yeah. So the second bit of the illustration is on 2023. So in this case, we're saying that the tax loss, it was actually a tax loss for the year of 80,000 Costa Lunan dollars. And remember that we are said in illustrations that in Costa Luna, the government allows companies to carry tax loss backwards to a previous year. So in this case, if you calculate 30% of 80,000 loss, you have a current tax income of 24,000 Costa Lunan dollars. What it means is that this 24,000 can be recovered back from the government if you have incurred more than $24,000 current tax on the past. And in this case, you can see that in 2022, $30,000 has been incurred. So what it means is that this 24,000 is recoverable. And that takes us to the current tax account. What does it look like? So we start with the opening balance of 30,000, which was the closing of the previous year. The closing of the previous year was 30,000 Costa Lunan dollars. And our current tax expense for the year, in this case, we have an income of negative of 24,000 Costa Lunan dollars. Again, the illustration says that tax of 30,000 has been paid, which is exactly the tax that was due for the previous year. It was paid in 2023. And that's what you've got there. And you then have a net closing balance of 24,000 Costa Lunan dollars. In this case, it is an asset. And if you look at it properly, the closing asset for the year is essentially the refund, which is based on tax rate multiplied by the tax loss for the year. And you remember that in the beginning, I talked about saying that if you can carry backward your loss to a previous year, then whatever asset accrued that is calculated thereof, you record it, you must recognize it as a current tax asset as at the end of the balance sheet day. So this illustration tries to drive home that point. And if you've got questions, please feel free to use the comment section and I'll try to respond to it as quickly as possible. The next other bit that I think we should talk about for current tax is the effect of enactments. And as you may know, tax is based on legislation, and the legislation are enacted by different instruments of government depending on what country you are operating from. And so what IAS 12 says is that, current tax liabilities or assets for the current period of a prior period shall be measured at the amount expected to be paid or to be recovered from the taxation authorities using the tax rates or tax laws that have been enacted or substantively enacted at the end of the reporting period. I mean, that's the background that IAS gives. But IAS does not tell you what's substantively enacted mean for each jurisdiction. So what it means is that practitioners need to determine what these things mean in their jurisdictions. But it typically means the point where that enactment cannot be changed, where it essentially becomes final. So the point where it's done. And even if it still requires a signature, as long as those additional efforts will not change what the law has been, once you have reached the point of finality, then that legislation has been substantively enacted. And so when you're doing your current tax calculations, what this point is saying is that as at the date of the balance sheet, as at the reporting date of the entity, what law was in force, was effective. That's the law. This is the basis of data that you're going to use to do your calculations. So if it happens that a new law was passed after the balance sheet date and it has no effect on what has happened before the balance sheet, I mean, if a law has passed after the balance sheet, it really does not matter. It does not affect your tax calculations. I mean, you may do certain disclosures to say, yeah, we've come to know about this new law, that it has a potential impact. But as long as that law has not been passed as of the balance sheet date, then it has no impact on the provisions that you need to book for the period. And we'll see, I'll just do one simple illustration to drive home the point. So this entity calls itself Cross Time Traffic Limited. It's a conglomerate based in Kingdom of Aldovia. The tax manager of Cross Time has determined that the taxable profit for the year ended 31 December 2023 is $5 million Aldovian dollars. So the question goes, it says, determine the current tax expense for the year ended 31 December 2023 based on the two scenarios below. Scenario 1, on 31 December 2023, the Kingdom of Aldovia amended the country's corporate tax legislation, changing the tax rate from 20% to 25%. The amended law indicated that the change applies to all profits relating to all financial periods ending on 31 December 2023 or later. I think I should solve this scenario before going to the second scenario. So in this case, the tax law rate is changing from 20 to 25%. It applies to all profits relating to periods that are ending 31 December 2023 or later. We've been told that the year end of Cross Time is 31 December. And the law was passed 31 December. So there are two things about the law. It was passed as at the reporting date. So as at the date the financial year was ending, there was already a new law. And the law states that it has effect on profits that accrues to periods ending on 31 December. It doesn't matter where that period started from. So it means that in this case, this law needs to apply on the profits for the year ended 31 December 2023. So instead of calculating tax as the usual rate of 20%, in this case, it's going to be calculated at 25%. And you see that in the illustration. So just look at the left, close your eye to what you can see on the right. So taxable profit is $5 million Aldovian dollars. We are using the new rate of 25% because that's the enacted rate as of the balance sheet date. And that gives you a current tax expense of 1.25 million Aldovian dollars. So if you go to scenario 2, the only thing that has changed is that the law was passed on 1st of January 2024. It means that law was not enacted as of the balance sheet date. The balance sheet date was 31 December, so it doesn't matter. So in determining the current tax for the period, we won't look at the rate that was introduced by the new legislation. We will focus on the existing rate, which is the 20% rate. But we may have to make a disclosure, a narrative disclosure, to say that, before the issuance of this financial statement, a new law has been passed and a new rate is this, and XYZ is going to happen. And so there will then be a prior adjustment in the next account. We'll talk about this much later. But it's suffice. The point I'm trying to make here is that when you're doing the current tax calculations, for the purpose of your provisions, You focus on the rate that was effective as of the balance sheet date. I mean, that may be different with what you submit to tax authorities. You can always do a prior year adjustment in next period, and that's what you see in the solution to the second scenario. $5 billion, 20% tax rate. Tax expense is 1 million Aldovian dollars. And the final bit of today's video is other concepts that are quite relevant. They're not as common. Okay, so the first one is not as common, but the second one is pretty much relevant. But we won't do illustrations of this yet. I'll just talk about them. So the first bit is about discounting. And this is standard accounting principles, IFRS principles. If the effect of discounting is material, accounting wants you to discount it. So if you've got tax liability that are payable over an extended period, and the impact of discounting with material. So for example, you're paying $100 million over a 10 years period. I mean, it looks like the effect of discounting may be material depending on the entity you're looking at. And so in those kind of cases, it would be nice to discount the current tax liability to present value, which you put within current tax, and the difference goes into some finance liability. Again, the standard does not require it, but the standard permits it. So an entity needs to make a judgment and, I mean, of course, have an accounting policy around this and implement that policy consistently. So you can choose to discount current tax liability when impact is material, and you can choose not to, but you've got to be consistent on your policy around it. The next bit is around allocation. In many instances, or in most instances, current tax will be booked into the P&L, the statement of the income statement or statement of comprehensive income, whichever you like. And of course, the other leg goes into your balance sheet. But there are a few cases where the current tax movement doesn't essentially go into the profit and loss account. It may go into OCI, it may go directly into equity. And the principle is simple. I mean, the tax follows where the underlying number is. So if the tax is entirely based on numbers that have come fully from the profit or loss account, then the tax fully goes into profit or loss account. If there are elements of the taxable profit that has come from OCI, then the tax on that element goes to OCI. So you may need to prorate, you may need to allocate your current tax expense for the period between P&L or between an OCI. Sometimes the underlying item is coming directly from equity, and you put the current tax element of that bit directly in equity. So we're going to do a more elaborate example, a bit of case study, and I'm going to try to test all these concepts across that case study so it's easy for us to drive on the point. And so that next video is going to be focused on that kind of case study and essentially take you through the practical steps of doing your current tax provisions and the kind of working papers you should keep. So I'll say thank you for listening to me today, and look forward to my next video on the other aspects of current tax. Thanks. Bye bye.